All right, so you're here, right? And I bet you've thought about this, maybe even more than you'd like to admit. What are the real odds in trading? Let's just cut through all the hype, all the noise, and just ask. Is this whole thing really just gambling? Like flipping a coin and hoping for the best?
Yeah, I mean, that's the million-dollar question, isn't it? Can you actually tilt those odds in your favor? Can you really learn to sort of play the probabilities and come out ahead?
That's what we're going to dig into today, right? This whole idea of, well, there's that statistic that gets thrown around all the time that only a tiny, tiny percentage of traders actually end up profitable. We're going to look at that statistic and see, like, why is it what it is? More importantly, how can you actually, potentially change that for yourself?
Yeah, and we're going to ground this whole discussion in some serious research, some really interesting data points.
Exactly. We're not just speculating here. We've got some solid sources we're going to be referencing.
Yeah, we've got the probability of profitability in trading, which is it's a statistical and behavioral analysis written by Sir Margin. And that's going to give us a framework, right, for understanding how these probabilities actually work.
So we'll get into the nitty-gritty.
Yeah, but then I think just as important, we're going to look at how this stuff played out in the real world, right? So we've got data from the Brazilian Securities Commission. There are a 2020 study on day traders. We'll look at some classic research from Barber and Udine that was published back in the Journal of Finance in 2000. And then, observations from the CFTC, the Commodity Futures Trading Commission, like, what are they actually seeing?
Right. Let's get real. Let's look at the numbers. What are the typical success rates for, well, folks like you listening right now?
Yeah, so the studies we're looking at, they kind of paint a pretty sobering picture, to be honest, at least initially. That statistic that gets thrown around, the 10 to 15% of retail traders actually making money consistently.
Yeah.
Yeah, it's holding up. It's holding up in the data. Like the Brazilian Securities Commission, when they analyzed day traders, they found that, let me get this right, just 11.5% were in the green after fees, after all those commissions.
So let's just break that down, right? Like imagine 10 people who want to start trading.
Statistically.
Yeah, statistically, maybe one, maybe two will actually make consistent profits.
Yeah, and it's, kind of a tough pill to swallow. But there is good news. These studies, they don't just give us the problem. They point to solutions, too. Ways you can actually change that whole picture for yourself.
Absolutely. No, it's not just the Brazilian study, right? Like this 10% figure, we're seeing it pop up elsewhere.
Right, and other research backs it up. Barber and Udine, they focused on something a little different. They were looking at how, well, overconfidence can make traders trade too much, which then ends up hurting their returns.
So they think they're better than they are.
Yeah, exactly. And they end up, making decisions that are, well, not ideal, to say the least. But their findings, they sort of indirectly point to the same thing. Most people just aren't beating the market consistently. And the CFTC data, consistent year after year. Around 70% of futures traders lose money. Flip that around, you're back in that 10-15% profitability range.
Okay, all right. Reality check done. The majority of traders not making consistent profits. But why? Like, what's going on here? What are we actually up against?
Right. And this is where things get interesting. These sources, Sir Margin's paper, the studies, they all kind of point to the same underlying factor.
Maybe roadblocks.
Yeah, the stuff that's making it harder for the average trader to succeed.
All right, give it to us straight.
So first off, transaction costs. Every trade you make, there's a fee, right? And if you're trading frequently, these costs add up. It can be real drag on your returns. Like imagine you're trying to win a race, but you've got like weights tied to your ankles.
Makes sense.
Then you've got those behavioral biases we talked about, overconfidence, maybe some fear and greed mixed in there, FOMO. They can really mess with your decision-making. Like Barber and Udine, they showed how these biases can lead to impulsive trading, taking on too much risk.
Right, not thinking straight.
Exactly. And then, perhaps the biggest one, informational asymmetry.
Big word alert. Break it down.
Basically, it means that the playing field isn't level. The big institutions, they have access to these lightning-fast data feeds, super sophisticated algorithms.
There's stuff we don't have.
Yeah, they see things, patterns in the market that most retail traders just don't. They're playing a different game.
So it's like they're reading from a detailed map and we're trying to navigate with a blurry compass.
Yeah, that's a good analogy. So yeah, when you put it all together, costs, biases, information disadvantage, you're starting off with a bit of an uphill battle.
Okay, so, it sounds pretty grim, right? Like, how do we even stand a chance?
Well, and this is the good news, right? The research also tells us that there are things you can do. You're not just stuck with these bad odds.
Give us some hope here.
Sir Margin's paper really highlights the importance of strategy, of having an edge. This is where things start to shift. He makes this really clear distinction between basically random trading.
So just buying and selling based on a feeling, like gut instinct.
Yeah, basically. Like, oh, this stock looks like it's going up, let's buy it. And he compares that to having a defined, tested strategy.
Something that's actually was proven to work, at least historically.
Exactly. So think of random trading like flipping a coin, right? Your odds are basically 50-50, maybe slightly worse because of those costs we talked about.
Right.
But when you have a strategy that's been back-tested, that's been statistically validated.
Something with a proven track record.
Yeah, like trend following, where you're riding those established price movements, or mean reversion, where you're betting on prices kind of snapping back to their average.
Like strategies that have actually been shown to have an edge.
Exactly. Now, obviously, no strategy is perfect, right? Past performance doesn't guarantee future results.
Yes.
But having a strategy, a tested strategy, it gives you a much stronger foundation than just guessing, than just going with your gut. It's the difference between, just playing the lottery and actually investing in a business.
That's a great analogy. So it's about moving from speculation to a more systematic, evidence-based approach. Okay, now another thing we hear all the time in trading is risk management. The sources really, really emphasize this.
Yeah, risk management, it's not the sexiest part of trading, but it might be the most important.
Explain why.
Because poor risk management, it can just wipe you out. No matter how good your strategy is, if you're not managing your risk, you're playing with fire.
So what, like betting too much on one trade?
Exactly. Sir Margin actually gives a really clear example of this. He says, let's say you risk more than 5% of your entire trading capital on a single trade.
5%? Seems small.
It can add up fast. Now imagine you have 5 losing trades in a row, which, let's be honest, it happens. It happens to everyone.
Yeah, you hit a rough patch.
Right. Well, with that 5% risk per trade, you've now lost 25% of your capital. That's a huge hole to dig yourself out of.
Yeah, that's tough to come back from.
Exactly. Now, compare that to a more conservative approach. Let's say you risk only 1% or 2% per trade. Same scenario, 5 losses in a row.
So much smaller losses each time.
Yeah, your overall capital takes a much smaller hit. You're still in the game.
You're not getting knocked out by one bad streak.
Right, and that's the key. Risk management, it's not about avoiding losses altogether. It's about controlling them. It's about making sure you can stay in the game long enough for your edge, if you have one, to actually play out.
I like that. It's about staying power, surviving those inevitable ups and downs. Now, we've got to talk about the market itself. The market is constantly changing, right? It's like it's a beast with a mind of its own. How does that impact all of this?
Yeah, market conditions, they matter a lot. Different strategies, they're going to work better in different environments.
Give us an example.
Sure. So imagine you've got a strategy that's designed for like a really strong uptrend, a bull market. You're buying breakouts, you're riding those momentum waves. It's working great.
You're killing it.
Right. But then the market shifts. It goes sideways, it gets choppy, volatile.
It throws a curveball.
Yeah. And suddenly that same strategy, it's generating losses. It's not working anymore. Or, let's say the market gets super volatile or really unpredictable. That can create opportunities for some traders, but it also increases the risk of, big losses if you're not careful.
So the strategy that was working perfectly, it's now your worst enemy.
Yeah, it can happen that fast. And that's why adaptability is so important. You can't just set your strategy and forget it. You have to be constantly watching the market, adjusting your approach.
So you got to be flexible. You got to be ready to change course when the market changes course.
Exactly. You got to be a student of the market, always learning, always adapting.
All right, now for the fun part. The mind games.
The psychology of trading.
Yes. How much does our psychology, our emotions, our biases, all of that, how much does it actually affect our chances of winning in the market?
It's huge, and the research is really clear on this.
Like how?
So Margin references this study from Nature Human Behavior back in 2021. They actually put a number on it. They found that emotional trading can reduce a trader's returns by as much as 30%. 30%.
That's a massive hit.
It is. Think about it. How many times have you made a trade based on fear or greed or FOMO? You abandon your plan because you get scared. Or you take profits too early because you're afraid of losing your gains.
Oh, yeah, I've been there. The panic sets in.
And then there's confirmation bias, right? This is where you start looking for information that confirms what you already believe, even if it's wrong. You ignore the warning signs, you downplay your losses, you tell yourself it's all part of the plan.
So you're basically fooling yourself.
Yeah, and that keeps you from learning, from improving. So this whole psychological side, it's absolutely crucial. You've got to be aware of your emotions, you've got to have a plan, and you've got to stick to it.
Discipline, discipline, discipline.
So exactly.
Okay, now this is where it gets really interesting. Sir Margin's paper introduces this concept of Bayesian updating of success probability.
Yeah, it sounds complicated, but it's actually pretty straightforward. And it's a really powerful way to think about your own trading journey.
Break it down for us.
So remember that 10-15% profitability statistic we talked about? That's like the starting point, right? It's what a statistician would call your prior belief about the likelihood of success in trading.
So basically they average the general odds.
Right. But Bayesian reasoning says that you can actually update that belief as you gather new evidence. And for a trader, the evidence is your own trading data.
So your personal experience can actually change your odds.
Exactly. So let's say you start trading and you're actually doing well. You're profitable more often than not.
You're beating the average.
Right. Well, as you accumulate more and more positive data, the probability that you're actually a skilled trader, that you're not just getting lucky, it starts to increase.
So the more I win, the more I can believe that I'm actually good at this.
Exactly. So Margin uses this example. Let's say you have a win rate of 75%. So you're profitable in 3 out of 4 months. That kind of consistent performance, it would significantly increase your initial probability of success.
So your personal odds are getting better. You're moving away from that initial 10-15%.
Right. And that's the power of Bayesian updating. It's not just about accepting the general statistics. It's about using your own data to create a more accurate, personalized assessment of your own abilities.
I love this. It puts the power back in your hands. Your success isn't predetermined. It's about what you do, what you learn, how you adapt.
Exactly.
Okay, so let's bring it all together. We've covered a lot of ground here. What are like 3 or 4 concrete things that someone listening right now can actually start doing to improve their odds, to move towards that, 30-50% success rate that Sir Margin suggests is possible?
Yeah, I think the research really points to 4 key areas. First, develop a statistical edge. This means having a strategy that gives you a win rate above 50% consistently. And just as important, make sure your average win is bigger than your average loss.
So even if you don't win every trade, your wins need to be big enough to make up for the losses.
Exactly. Second, risk management. Risk management, risk management.
Can't emphasize that enough.
Right. Always use stop-loss orders. Be smart about your position sizing. Don't put too much capital at risk on any single trade. And consider diversifying so you're not putting all your eggs in one basket.
Spread the risk.
Yes. Third, be adaptable. The market is constantly changing, so you need to be willing to adjust your strategies. What worked last month might not work this month.
Stay flexible.
Exactly. And finally, track your performance. Keep a detailed trading journal. Write down every trade, why you made it, how you felt, what the outcome was.
So you can actually learn from your mistakes, see what's working, what's not.
Exactly.
Yeah.
It's all about continuous improvement.
This has been incredible. So the takeaway here, folks, is that those initial statistics on trader profitability, they're not the end of the story. They're just a starting point.
Yeah, they're the average. And you don't have to be average.
Exactly. The research shows that you can actually change your odds by making smart choices, by being disciplined, by learning and adapting.
And by updating your beliefs based on your own experience.
Love that. So as you're listening to this, think about it. What's one thing you can change about your trading right now that might actually move the needle? Or how can you use this idea of Bayesian updating to actually rethink your past results and your future potential? It's all about taking control, taking ownership of your journey in the market. Thanks for joining us for this deep dive.
Absolutely. It's been a pleasure.
And we'll see you next time.